Stocks getting a boost after Fed Chair Powell's earlier comments signaling progress has been made on inflation. My next guest expects stocks to continue climbing in the second half. She's raising her year-end S&P 500 price target to 5,700. Joining me now here at Post 9 is RBC's Lori Calvasina. Lori, good to see you.
Thanks for having me.
You raised the target. Your models are pointing you in that direction. You characterize it, though, as a little bit of a reluctant one. Why is that?
Well, I think I called myself a nervous, jumpy bull.
Yeah.
And look, I see the case for further upside on some of the models. You know, AAII is something I talk about a lot. I've been expecting it to go over this one standard deviation mark eminently.
Yeah, the retail sentiment.
And it just hasn't done that. It's stuck right below. So I have to sort of, own that, right? And looking on a 6-month forward basis, you still tend to be up about 4.5% from the level that it's at. That being said, if we get too much more enthusiasm in this market, I do think it's going to cross over into dangerous territory. So, I can see the case for a pullback being made. I think if we end up getting one, it's a 5 to 10% drawdown, something similar to what we got in April. It doesn't derail the year. It doesn't derail, sort of the upward path, a pothole, essentially, is sort of how we see it on the path to recovery.
Got you. So the other piece of it, you mentioned sentiment as being one of those things that's kind of nagging at the bull case. Valuation, you've been pretty consistent in saying that, look, as much as it seems like 19, 20, 21 times earnings seems expensive.
Yeah.
Your work said maybe not, given other conditions. What is it saying now?
So this is also something I had a hard time wrapping my head around. And, I've sort of talked about that a lot the last couple months. But the valuation model is pointing to about a 21.5 times PE on a trailing basis at the end of the year. That's due to a ramp down in inflation, a little bit of relief on the Fed, a little bit of relief on the 10-year. And when we marry that up with our earnings number and consensus, that gives me a range of about 5,200 to 5,300 on the S&P. We have made some changes to our earnings numbers. If you put in a more sort of optimistic view on inflation in the Fed, we can get that number up to 5,500 for you. So that's still a little bit over where we are. So I would say, I'm in sort of a weird spot right now on this model because it does feel to me like the market's a little overbought. I've done this for almost 25 years. I mean, I know markets can stay overbought for a while, and it feels like we're more sentiment-driven right now than anything else. So we think we're going to have to deal with that at some point, but at the same time, I took my models out to 2025. And I can come up with a 6,100 scenario on the S&P, just sort of looking at plain vanilla consensus arguments for inflation moderating a little bit, a few more Fed cuts. So I can see where we can still make a case longer term from a valuation perspective.
Yeah, so we're talking like 10, 11% up from here or something like that.
Right. And so it's nothing heroic, you know. I mean, these are not, huge percentage gains. They sound like these big, crazy, bullish numbers.
Yeah, exactly.
Right, and they're not. And look, we've been very honest with people. Our targets are a compass. They are not a GPS.
Sure.
We are going to revise them. Breaking news. I mean, that is what strategists do as new facts come to light.
Yeah.
But it was helpful to really kind of do the math and really study 2025 hard and kind of put everything into context.
This move higher just recently in Treasury yields, it always gets the market's attention, I think, especially when it comes along with somewhat softening economic numbers or the fact that we got a pretty decent inflation report on Friday. Do you see it as a challenge, or is there a level where it would be a challenge?
It is something that concerns me a bit. I mean, I actually emailed someone this morning and said, how high are yields going to go? And I didn't get an answer back. But the reality is I've done some work, and if you go back and just look at stretches, both rising and falling rate environments when the 10-year Treasury yield is moving up, over that same duration, if the stock market is going to go up or down, seems to be dependent on how much yields move from their original starting point. So something kind of, 300 basis points, 275 basis points, market can't handle that. 100 basis points, 200, market seems to be able to weather those kinds of storms.
Yeah, I mean, you could just look back in the last couple of years, I guess. There was a time we thought 3.5% or 4% was going to be a problem on the 10-year, and we got through it. In terms of parts of the market, the whole few versus the many trade, where do we emphasize now?
So, look, I feel like maybe I'm still a little bit stuck in neutral on these rotation trades. I look at, something like growth versus value. I think that there are a lot of reasons to be concerned about growth and seeing a rotation. Positioning's getting crowded again. Valuations have been bumping up against a 30-time PE, which it can't seem to break through. But at the same time, we know that for value and cyclicality and small cap to work, you need economic enthusiasm. We're heading into a period where GDP forecasts are kind of going to below average levels for a few quarters. We're seeing some downward revisions to 2024 numbers. That's not a recipe when people say, hey, I don't need any more of my safe secular growth stuff. Let's go put on some risk on cyclicality. We just have to be a little bit more patient.
Right. So the way this market for a long time has played defense in part is to buy secular growth and assign a greater premium. on that. You mentioned we can't get through 30 times, so you're looking at kind of like the NASDAQ 100, or is it, mega cap growth segment?
I built my own basket. I kind of got fed up because people kept asking me to run Mag 7 baskets over 20-year stretches, and I was like, well, the Mag 7 wasn't the Mag 7 20 years ago. That doesn't make any sense. And so I took a basket of just rebalancing the top 10 market cap names in the S&P 500. We rebalance it every month, and we've gone back to the late 80s to look at, just different. We've run like 20 different studies, from valuation to earnings and that sort of thing. And if I do that basket on a rebalanced basis, in 2021 and 2022, it got close to 30 times a couple times and couldn't break through. And what we've seen recently, I think the highest stat I've crunched on that over the last month or so was like 29.8, and it's now drifted back down to around like 28 or 27. But that kind of 30 level, it just can't seem to break through this time around.
Got it. All right. Well, we'll keep an eye on that among all the other things. Lori, thanks a lot.
Thanks for having me.
Good to see you.